Welcome to Standard Chartered India Money Insights, a podcast series that brings you topical insights and local perspectives on India's markets from the experts.
Hello everyone, welcome to another episode of What is Driving Markets, where we look at key market events which could influence asset class performance and your investment strategy. Hi, I'm Vinay Joseph, the host for this episode of the podcast. Now, the Middle East confluence has moved into its fourth week. So, a quick recap of how market has performed and where do we see it going. Now, Indian assets have been under selling pressure since the start of the month. Indian equities have fallen sharply, down around 8%, on track for its worst monthly performance since March 2020. The tumble in stocks has pushed Indian equities in pullback territory, that is, a peak to trough fall of 10% or more, with the Nifty index down about 13% from its recent peak. Bond yields have surged, with short-term yields up 20 to 40 bips since the start of the month, while the benchmark 10-year bond yield is up 12 bips to 6.78%, largely on the back of RBI intervention, which has kept banking system liquidity in surplus. The INR has depreciated against the USCP, hitting several all-time highs amid broader USD strength and elevated foreign investor selling, both in equity and debt markets for India. The market narrative is clearly focused on escalating geopolitical tensions. Investors are in a risk-off mode, as the ongoing Middle East tension drives energy prices sharply higher, making investors price in a higher risk of an economic and earnings slowdown. India's oil dependency has reduced over the years amid improved efficiency and a shift towards alternate sources. Nevertheless, the economy is not immune to crude fluctuations, with significant impact on macro variables and equity markets, which is higher to its Asia and emerging market peers. We had covered this in detail in our March outlook of the India Market Outlook. Please reach out to your relationship manager for a copy of that report. Now, coming back, what does this all mean for investors? The key critical variable is how long oil prices stay high. This is an important distinction because its impact on inflation and other macro variables is likely to be fleeting if crude oil price gains do not sustain beyond a few weeks. Conversely, a downside scenario where oil prices are high for an extended multi-month period would likely be more damaging towards inflation and growth and result in knock-on impact on equity and bonds. At present, our CIO's view, we assign a 70% probability that oil prices will peak in the coming 3 to 4 weeks as this conflict eases. If the impact is short-lived, then the key question on investors' mind is, are we approaching a bottom in risk assets? One cannot answer this question with certainty, but few factors below indicate it might be time to add to correction. First, domestic macro fundamentals are still strong. It was only in Feb we had the US-India trade deal signed and we had a growth-focused union budget, which was on the back of past policy measures, both monetary through front-loaded policy rate cuts and liquidity injection, and fiscal, while income tax and GST rationalization in 2025. All this was pointing to a strong domestic demand revival in the coming few quarters. Now, this could cushion the impact of a moderate and temporary oil price shock, which is our base case. Second, corporate earnings cycle still remains resilient. The above policy measures support a reflating economy, with equities likely to deliver double-digit growth in the coming 2 years. Consensus expects Nifty index to deliver 16 and 14% earnings growth for the fiscal year ending March 27 and March 28th, respectively. Valuations have moved below fair value. Now, this is important. India's equity valuations, both absolute, if we look at 12-month forward PE and price to book, as well as relative to bonds, earnings yields versus bond yields, and price to earnings ratios relative to emerging market peers, all have turned attractive. They are below fair value, which indicates that the risk reward for equity markets has turned favorable. Lastly, there could be a possible bounce from oversold condition. Looking at past pullbacks from 2005 to 2025, the current 13% pullback is in line with average duration and magnitude. In addition, foreign investors have sold close to $10 billion in both equities and bonds. This is one of the largest monthly numbers of outflows in many years. And finally, risk sentiment shows extreme bearishness towards risk assets. Nevertheless, a downside scenario where oil prices stay high for an extended multi-month period is a probability which we assign 30%. And this would be more damaging for growth and inflation and would have negative impact on equities and bonds. Thus, it is important, along to add with corrections, to diversify, avoid concentration, and build hedges. And we think this can be achieved through three ways. Within our overweight of equities, we have an overweight on large cap equities over mid and small cap. We think it would do better given a greater margin of safety, both in terms of earnings and valuation. Second, we have a preference for bonds over cash, which does well in this environment, and a preference for short maturity and high quality bonds. Lastly, we have a preference for gold and multi-asset strategies, which would act as a portfolio hedge against inflation risk as well as equity market volatility. That's all for this episode of the podcast. I hope you liked it. In case you liked it, please like and subscribe and stay tuned for more. Thank you.
Thank you for listening to Standard Chartered India Money Insights. Stay tuned for the latest updates and market trends by subscribing to our podcast. For more information, reach out to your Standard Chartered Relationship Manager or visit www.se.com/in.